Trevor, thanks so much for joining me.
My pleasure. Thanks for having me on.
There are many things I want to get to, but let's start with the hard issue politically, but the easy issue from an economic perspective, which is the price on pollution, the much debated price on pollution, the tax on everything. And you have articulated a strong defense in some ways, which I want to get to, but I want to start with, I think, an incorrect premise that some people put on the table, which is the price on pollution is causing food prices to run away from us. The price on pollution is causing lineups at food banks. What do you say to the politicians who try to weaponize the real fear and frustration people have around cost of living and point to the singular cause of the price on pollution?
So I think here it's natural that concern around affordability is top of mind for many, and of course that's going to motivate political leaders and governments across the board to have as a priority issue. But here, inflation rose to the levels that it did, over 8% in 2022, the fastest we've seen in a very, very long time, not because of any one thing. There were a lot of contributing factors that overlapped and interacted, but carbon taxes was very, very far down the list of drivers of consumer prices that we've seen. Estimates of this vary, but let me give you a couple. So StatsCan does this for all of the taxes that we have on products, so the GST, tobacco taxes, and so on. They measure what inflation would be with those taxes and without, and they release it every single month, and they've been doing this for years and years on end. And the contribution of all of these taxes on products, carbon, tobacco, GST, everything, is adding about 0.1% to that year-over-year change in consumer prices. So that's certainly not zero, right? It's a measurable effect, but it is not something that'll get you from a 2% inflation rate to an 8%
And that's all
inflation rate.
taxes. And that's all
That's all of
taxes.
them. Yeah, all
So
gas
so let's
taxes
break it
too, so
apart.
all the indirect
So
taxes
let's
that we
break it
levy.
apart and singularly focus on the Trudeau's carbon tax. What's the you look at 20%, more than 20% food inflation over the last
Yeah.
number of years, and what percentage comes from the price on pollution?
Right. So you're right. Food prices rising well over 20% here just in the past couple of years. If we were to think about by how much would have food prices increased if we had no carbon taxes whatsoever, this is going to vary across provinces. So I'm going to pick British Columbia just because it's a jurisdiction that has the longest history of the broadest based carbon tax of any jurisdiction in Canada. So myself and University of Calgary colleague here, Professor Jen Winter, have a piece last year kind of quantifying this by a lot of different products. And our estimate for food, all in, the effect of carbon taxes on food prices is 0.3%. So
0.3% of
0.3.
20%.
Exactly. So that would be compared to no carbon taxes whatsoever. How much would food prices fall by? About 0.3%. And that's all in. That's not just the direct effect. It's including all indirect effects too. Many note correctly that if you ship something by truck, there's going to be some effect of carbon taxation on the cost of that transportation service and therefore the price of the good that you buy at the store on the shelf. That's certainly true. But you add all this up, you get about 0.3%.
And what
And
do you make? Can I ask, what do you make of the? It's real easy politics when someone says we're going to cut a tax, axe the tax. It's funny, people have gravitated to these rallies, but axe the tax has been a slogan used in other jurisdictions, in other points in history around other taxes. That it's easy to rail against a tax, especially and it's easy to make something popular where people go, oh, I'm going to get taxed more. I don't want that. But when you look at the slogan technology, not taxes, as a way to deliver solutions on climate from a government facing perspective. This is my view of things. I wonder what you think. You drive technological change and innovation by making sure that you address the market failure that is climate change, where we are pricing things ineffectively. Pollution is not priced adequately, and so we aren't seeing a drive to clean alternatives in the private sector the way we otherwise would. And we are starting to see more of that happen as we have an industrial carbon price, as we have a consumer-facing carbon price. But if you scrap all that, and maybe the Conservatives don't want to scrap the industrial side, we're not entirely clear on that, but I would guess that they probably don't end up scrapping that, and they just scrap the consumer-focused side. But regardless, if it's technology, not taxes, how are you going to get that technological innovation without a price signal?
So that's
Unless
a
it's
really,
subsidies, in which
yeah.
case that sounds like taxes. I don't
Yeah,
know.
so, yeah, that's a great question and really does get to the heart of the debate, broadly speaking, around how to structure climate policy in any jurisdiction. You could, or at least how economists think about it in general, is you have market-based approaches and you have what I guess is less generously called a command and control approach. And both can lower emissions, no question. But then we need to ask, at what cost per ton? Each ton that you put into the atmosphere has a cost in terms of its contribution to climate change. And these costs are borne globally. And so the costs of you and I, as individuals, as households and families, or as businesses, when we emit a ton, we don't face most of the costs of doing so. And so then we tend to emit too many tons because we're not bearing the consequences of each of those. What's the estimate of the cost per ton? We don't know precisely. Governments do struggle with, and researchers struggle with quantifying this, but most recently from the federal government in Canada, at least, that what's called the social cost of carbon, it's somewhere on the order of maybe $250 per ton. And there's uncertainty around what that
Sure.
number is. But so what a carbon tax does is it basically ensures that you as an individual are making decisions based on something that reflects the fuller cost of your actions. And so if there are cheap and easy ways to avoid emitting a ton, then you'll opt to do so. And there's lots and lots of little things that each of us do that can add up in aggregates. We're making millions of decisions every day, everyone in different circumstances, having different opportunities or different options to change behavior. And the carbon tax then creates an incentive to do the really easy things to lower emissions and the cheaper things to lower emissions. And that's really the strong merit for the carbon tax. It's a broad-based incentive and just gets everyone to think about what is best in their individual circumstance. And sometimes that means not lowering emissions, right? If you only have high cost options, then it might be worthwhile paying the carbon tax.
It's
So
amazing to
that
me that we
decentralized
are.
approach is why it's generally cheaper to lower emissions economically using these kind of policies.
It's amazing to me that we are still debating the idea of the tragedy of the commons, and here we are, I don't know, what is it, 50 some odd years after the term was coined, and we're still struggling to understand what this idea of a collective action problem, where I don't have an incentive to save the planet. You don't have an incentive to save the planet necessarily, at least from our wallet's perspective. And so, yeah, there's a market failure here. The externality is not being internalized properly, and you need a price signal to change that.
Yeah.
But you rightly mention that in some cases it is not it's not going to be either the decision one makes to reduce emissions regardless of the price, or it's impossible. So there are certain circumstances one faces where, let's take a local example here, where there's a single parent who's going to want to take their kid to a baseball practice out in Scarborough, and transit is not going to be reliable enough sitting here today for many of those families, and they're going to drive. And it's going to, they're not in a position necessarily today to shift over to an electric vehicle and purchase a new vehicle. So where does that leave them? Well, it leaves them polluting, yes, but also paying a little bit more as a result. And so the rebate is designed to mitigate against circumstances like this. And this has been a great political debate in the House, where the PBO report, which I'm sure you've read forwards, backwards a few times over at least, the PBO concludes, on the one hand, on a fiscal basis, cash in, cash out, that households are made better off, or 80% of households are made better off. But then they conclude on an economic basis that a majority of households are actually worse off when you consider the relatively modest, small GDP hit of the price on pollution. I met with the PBO, and I wonder how you would articulate this. I met with the PBO and I expressed some frustration, I'll be honest, because the fiscal transfer analysis makes good sense to me. The economic analysis in a vacuum makes no sense at all. Because unless you are also analyzing the costs of unchecked climate change, unless you are analyzing the costs of alternative action, their job is to inform parliamentarians. But what am I informed by in any useful way if all I see is there's a cost to this singular policy, unless I'm also told, as they ultimately do conclude in conversation at least, that it is the most effective and efficient mechanism in comparison to other things. But that's
Mm-hmm.
not in their report. And so what am I to make of the economic analysis? Is it of any use to a parliamentarian like me?
I'm a big fan of the PBO, so I'm going to put my bias right there at the
Me too. Me too.
at the start. And their report, I think, from an external observer of the political conversation in this space, it was really interesting to see the PBO report become such a source of partisan back and forth, let's say, and because they do have these two estimates, if you note, the fiscal and the economic, and they have two kind of different conclusions that you might draw. I think the most important thing to keep in mind before anyone even reads the PBO report is that lowering emissions, changing how we do things, isn't going to be free. There are going to be costs that need to be incurred to achieve the benefits of lowering emissions, and we should be upfront about those costs. And some are not upfront about those costs. Some put climate policy forward as though it's a free lunch. We can lower emissions, no problem. And by the way, it's only going to boost economic growth. And I think that's kind of misleading as well. So the PBO puts out in their analysis how much slower GDP growth will be in the years in which we're increasing the stringency of climate policy. And their estimates are very close and in line with what you see even from Environment and Climate Change's Canada and some of their estimates from independent groups like Fiscal. I did a lot of interesting work in this space. So it'll shave a little bit off of growth, and that does add up over the years. And then the question is, well, are the benefits worth those costs? And the benefits are in terms of having emissions that are lower than they otherwise would be, and not having the costs associated with climate change as large as they would have otherwise have been. And that's why measures like the social cost of carbon is really important. If we
can I ask on this too?
Yeah.
Sorry to cut you off. I'd read a piece, I think it was in the Financial Times, that described insurance premiums and the increase in insurance premiums as a hidden carbon price. And so there are ways we are going to pay for a changing climate in many different ways, but possibly not in such a direct upfront way.
Yep. No, that's absolutely right. And quantifying the costs and consequences of climate change is something where there's a great deal of still ongoing work done by many, because these costs are going to manifest themselves lots of different ways, especially when we're thinking about timescales in the decades. And so it's a really hard problem to try and just boil everything down to what's the cost of emitting 1 ton, for sure. So with that caveat in mind, we do have an estimate, at least for the purposes of Canadian policymaking, of $250, give or take, per ton. And so if the costs per ton of, say, the carbon tax are less than that per ton, even including the economic costs, then it's a policy that is worth doing, in the sense that the benefits exceed the costs. And this is what I think really leads the conversation with respect to the PBO report to fall short among those who don't like the carbon tax. And there are rational reasons, and we can talk about what are the rational reasons to oppose a carbon tax. But those that don't want it, then the question needs to be, okay, then what's the alternative policy to lower emissions, if not the carbon tax? And generally speaking, although there are exceptions, those policies tend to be more expensive economically. And so if the focus is on, at the end of the day, whether the economic costs per household are too big, then the policy is not to replace the policy proposal shouldn't be about replacing an efficient policy with an inefficient one. should be doubling down on the efficient policy.
You mentioned valuing the PBO, same, and my frustrations were alleviated a little bit when the PBO in that meeting came back to me and said, we acknowledge that the price on pollution is the most efficient in measure to reduce emissions. They've acknowledged as much in media interviews as well. And then Yves Giroux said to me, he'd been at a conference and used this example, but he used this example to me as well, that it's a lot like sending weapons to arm Ukraine. He's like, it's easy to quantify the upfront costs. It's hard to quantify the long-term benefits, but you know it's the right thing to do. And some of that message obviously has been lost, and he's in a rock and a hard place. Between a rock and a hard place, his job as a PBO is to cost a single measure. It's not to provide this expansive analysis. But again, I put to him as a parliamentarian, his job is to inform me. I'm not the most informed if I'm only looking at the singular policy in a vacuum and considering the economic costs in a vacuum. Okay, I wasn't going to ask this, but
wait.
Go ahead.
I want to pick up right on that point. Yeah. So you're right to note that the PBO is a mandate and it's going to fulfill that to the best of its ability, but perhaps its mandate is too narrow. And I don't mean to suggest we should expand the PBO mandate. I mean, maybe what Canada should think about reviving is something that we used to do through an entity called the Economic Council of Canada. This existed for many decades, and it would put forward analysis on all sorts of issues, and it would be much more all-encompassing in the analysis that it put forward. And having an entity like that might also help facilitate more productive, difficult conversations like this, where if we're just picking up one narrow slice of it, like the financial implications alone, we might be missing the bigger picture. And so this, I guess to listeners who hadn't heard of it before, this is something that we started in the 50s in Canada under a different name. And then it was disbanded in the early 90s, late 80s.
Interesting. The U.S. still has it, though.
So the U.S., they have the Council of Economic Advisors, and that's a little bit different in the sense that it's much more directly connected to the administration. Yeah. And so it's naturally seen as, I don't want to say more partisan. It's well-staffed. An arm of the president. It's an arm of the president's office. So it's not an independent, congressional body.
Understood. I wasn't going to ask this, but you said there are rational reasons to oppose carbon taxation. I don't get that sense in the House of Commons at the moment. And so if you were on tour to dismantle the carbon price, what are those rational reasons?
So the rational reasons might not make the most politically impactful argument, let's say, but the cost of the carbon tax to you as an individual is more than the dollars and cents involved. There is a psychological cost, if you will, of paying taxes, and those psychological costs differ by tax. Those that you're exposed to frequently and in bite-sized, digestible amounts are easier to recall, and they are front of mind a lot more, and are therefore potentially much more unpleasant of a tax from the perspective just an individual's experience. And so something about the GST. The GST is not popular. Right when we introduced the GST, just looking back over even House of Commons debates when they passed it, when the vote happened, you had people in the gallery throwing rolls of toilet paper down onto the floor of the House of Commons. It was a difficult conversation, an unpopular tax then, and it quite frankly makes the carbon tax debate today seem tame. And that is because it's much more visible than many other types of taxes. And not being a psychologist, I can't speak to, what are the policy design details that might lead that to be the case or not. But now I think about Quebec. They have cap and trade in a way that's hidden. A lot of Quebecers don't realize they're paying a carbon tax because it doesn't really appear on the bill. It's embedded up the supply chain. So there are different ways of implementing carbon pricing that's more visible. than others. And so having a visible tax, I think, on the one hand, makes it clear why it's there. We're trying to incentivize people to change behavior. We want
Yeah.
people to avoid paying the tax. That's the whole point. But it might be, for psychological reasons, more painful in a way that we should
But do
also
you, so
incorporate. And so other policies that economically might be more costly, say a subsidy for different types of areas to incentivize behavior, on some psychologically adjusted basis, those might be less costly, which is a very fluffy answer, but I think a rational one that we see in other
see,
topics.
I would dispute that a little bit insofar as it's an understandable response in the sense of I, on a daily basis, might be frustrated with something that I see on a daily basis. And so it's rational from the perspective of I can rationally understand someone reacting to something in that way. It's
That's fair.
not rational from the perspective of I want to kill the most efficient and effective way just because I don't like seeing something, knowing I'm going to pay more through an alternative policy. That's deeply irrational when you get down to it. But it's
Yeah, yeah.
psychologically it's understandable that one might react to something on a day
Okay.
to day.
Now let me give
It
you a
does.
hard head rational one
Okay.
that's not about psychology. The purpose of the tax is to incentivize behavioral change where the cost of that change is lower than the carbon tax. We want to adopt the cheap ways to lower emissions.
Yeah.
And you noted this earlier. Sometimes there aren't possible behavioral changes. And
Yes.
so an economist would label that an inframarginal choice rather than a marginal choice, which is one that could actually be moved in
Sure.
response to the carbon tax. I think about, say, diesel electricity generation in the north, or aviation fuel for fly in, fly out communities in Nunavut.
Yep.
These are just probably emissions that there does not exist at the moment an alternative. And so we exempt them from the carbon tax right from the very beginning.
Yeah, exactly. Yeah.
And if you knew where these inframarginal sources of emissions were, then not taxing them results in no effect whatsoever on Canada's emissions trajectory. Like you can exempt inframarginal activities from the tax.
Whether you tax it or not, it makes not a lick of a difference.
Exactly.
Yeah.
And it may very well be that most decisions, at least in the short term, maybe even the medium term, are inframarginal decisions. And so you are getting a lot of behavioral choices that we take subject to a tax that itself is not, there's no alternative to respond. But longer term,
but I
we have
think
options to change the type of vehicles, or
yeah.
even in the north, different types of electricity generation that can be explored.
I think that probably is true, but it's temporal in a way, in that I'm not going to replace my furnace at 5 years old just because of a modest price on pollution that I know is going to rise over the coming years. But if I'm set to replace my furnace, I'm probably going to replace it in a more efficient way because I know the price is in place. And so I take the point, but again, I think it's sort of an argument at the margins in some ways. Okay, I don't want to dwell too much on carbon pricing because that's where we 100% agree. Now we're going to move to areas where I think there's agreement on this second one, at least in part, and that's capital gains. So we're staying on taxation. And the government recently put in place, in the budget, they've proposed changes, and those changes are going to be realized through budget implementation legislation. I think is going to be actually, from what I've read at least, is going to be separated from the overall budget and specifically focused on capital gains changes. And the idea is, for those who, you might want to better set the stage than me, but the idea is at least that right now you are paying taxes on 50% of your capital gains. So what they call the inclusion rate is 50%. And what the government is proposing is on capital gains for an individual on an annual basis over $250,000. Every capital gained earned dollar over $250,000 is now going to be subject to an inclusion rate of 67%. And so you're going to be 67% of those earnings is going to be subject to your personal income tax rate. Now, I think frustration for some is if they've used a Canadian-controlled private corporation to structure their lifetime savings and they've got passive investments through that corporate vehicle. So the one distinction to make is that $250,000 limit before the new rate applies is not subject to corporations, likely because you could abuse such a system and have many corporations in operation. That would be my expectation. But anyway, that's all to say, every dollar of capital gains earned within a corporation is subject to the 67% inclusion rate. So that's the stage, and it raises something like 17 point something billion dollars here. I've seen higher estimates, but I don't think that accounts for some of the costs. And so I think it's a significant sum of money over 5 years being generated. And it's one of the reasons that Tiff Macklem, the Bank of Canada governor, was able to say, well, we don't see this budget as a real problem in any way. From an inflation perspective, we don't see it, causing any problem for us, because at the end of the day, it's money out, but it's also money in, and overall, it's a bit of a wash, and we don't see this impacting our rate cut decisions at all. So that's the stage being set. There have been doctors, there have been entrepreneurs, there have been, certainly in the tech sector, people coming out swinging against these changes. You wrote an article in defense of these changes. Walk us through that defense.
Sure. So when I think about the capital gains inclusion rate, I'm thinking about, as you put it, the fraction of gains that we're going to count as taxable income. Before it was half, and then now we're moving to 2/3 above a threshold, subject to the details that you noted. My view of this is, okay, on the one hand, why do we treat capital gains differently at all? Like, why is one source of income different than another? And a very important source of capital gains for many is you hold shares in a corporation that generates profit, hopefully, and increases its share value. And so you as an owner are receiving value in the form of maybe dividends or in capital gains, if the company does share buybacks, for example.
Sure.
And we partially include capital gains not at 100%, because corporations themselves also pay corporate income taxes. So they'll generate profit, they'll pay taxes on that, and they'll pay owners out of the after-tax income that they generate. And with dividends, we have some formula that we won't need to go through. It's a complicated formula that basically, at the end of the day, leaves dividends from the perspective of an individual to be treated very similarly to a dollar earned as interest or a dollar earned as wages and salaries. So dividends, interest, wages, salaries, at the end of the day, have the same fraction taxed by governments.
A buck is a buck. However you earn it, that's the idea.
Yeah, among those bins. But capital gains stands out as having a lower tax rate applied to it. So imagine you're a very high income individual, a top of the income distribution in the top bracket. If you earn $1 in salary, then the effective marginal tax you face is 53%. Same tax as if you earned $1 in interest. Roughly the same as if you earn $1 in dividends. With capital gains, your tax rate would have been a little bit less than 46%. So there's this gap between the tax rate we're applying to any other source of income versus capital gains. And that change in the inclusion rate, what it did was to, not perfectly, but roughly equalize the tax treatment, moving the capital gains effective tax rate from a little under 46 to just over 52. Pretty close to all the other income sources. So this change now means that $1 earned in capital gains, interest, wages, dividends, all effectively have the same tax rate applied to them. And that, I think, is something that is positive for a tax system to have as a feature, where we leave it to businesses to think about what's the best way to distribute value, dividends, capital gains. Let the circumstances and the economic fundamentals that they face determine that choice, rather than having the tax system put decisions one way or another. So having a neutral tax system does generally mean not biasing the income sources that people receive these values from.
Well, I want to go further because I had this. I sometimes do silly talk radio, and there's a conservative host, and we were going back and forth on this, and we kept going back and forth because that's what we do, even after they stopped recording. And I put it to him. I've got a friend from undergrad who inherited a good amount of money from his father when his father passed, and he invests it in the stock market. He's a passive investor, and dividend income is one thing. Okay, it's as you say, a buck is a buck. But why should his passive investment gains on the purchase and sale of those stocks and equities, why should he? I don't know what productivity gains the country has seen based upon that passive investment activity. Why should he have a preferential tax rate versus the nurse who is busting his ass at the hospital in Sarnia where my father-in-law just passed? I don't understand why we would be treating those forms of income differently. And if we do, I kind of would want to preference the nurse who's busting their ass, if anything. So,
Yeah.
what am I? And it's not a new thing. Warren Buffett did a tour with his secretary years ago, Debbie Basanik, where he was paying a lower effective tax rate than she was paying. It seems deeply unfair.
So I won't speak to fairness. I guess I'll leave that to others. I mean, neutrality in the tax system does lend itself nicely to normal intuition around fairness. What makes capital gains differently? Well, some do have arguments around why capital gains ought to have a lower tax treatment than wages and salaries. And so there's a couple. So I think three that I think are the strongest, maybe counter arguments, let's say, to what
Sure.
you said. One is there's risk. When you invest into a new business or a new facility, you make some upfront investment that will later pay off. And if it does pay off, often those gains to you as the innovator is in the form of capital gains. You grew the value
Sure.
of this company. That's what capital gains are. So you took a risk. And so having that reflected in the tax code is valuable. Second is you have to wait, right? Income from wages and salaries, this is a flow. Capital gains, this is a very lumpy stock where you make an investment and it might be years before you see a return on that investment. And why is that relevant? Well, inflation, all sorts of things are going to happen between the time you made the investment and the time you sold your business. And then third is that when you make that investment, you're kind of locking in a lot of your wealth, let's say, into that entity. It's very hard for you to sell. So you face like a real liquidity problem that's different than normal employment income that is just this flow that you're paid on a regular basis. And those are, I think, all valid points for thinking about the tax system generally, but not arguments specifically to treat capital gains differently. We could think about having risk better incorporated into the tax code in general. Like if you lose money, in some cases, you can offset gains you've made elsewhere.
Well, pause there because
Yeah.
people have not talked about this in the course of the capital gains discussion. But capital gains are still massively preferenced from the perspective of that carry forward losses, right? So you are able to offset your gains with your losses to accommodate that concept of risk. Also, one would think that the market determines your reward based upon the risk you take. And so why is the tax code further preferencing a particular activity?
100%. So these counter arguments don't. This is what makes it an interesting discussion. There's counter arguments to the counter arguments, and you're right. Risky things, they will have higher rewards, as they should. Safe investments tend to pay lower returns than risky investments, and so the market will determine what that risk premium should be, and the tax system should be neutral with respect to that. The ability to write off losses against gains, we do that in a partial way. We could broaden how we allow for losses to be written off. So there's a conversation there, but note that we can talk about risk and taxes in a way that's involving many more levers of the tax system than just the capital gains inclusion.
Yes.
Then the time, waiting years, if you made $1 of investment, a few decades ago and it grew to $2 today, you're really no more ahead in terms of the inflation adjusted gains. But the simple solution there is to have inflation indexing as part of the way we calculate capital gains. We have inflation
Right.
adjustments for tax credits and brackets and all sorts of other aspects of the tax code. We could
You,
think about
you
inflation adjusting for capital gains too.
you mentioned the lumpiness to it. I mean, the same could be
Mhm.
said if you are a hardworking actor and your gains
Yep.
come in spurts, really, and
Yep.
other countries have income averaging on that front.
Yep.
Uh, it makes less sense though in the case of a passive investment. Here you have someone hard-earned employment income that is lumpy. Okay, I kind of want an income average there. When you look at passive investment, someone's bought a resale, a rental property, I should say, that they are earning income on that rental and investing in the property and fixing it up and all that with the rental income. That's fine.
Yep.
But why are they? It seems like a massive windfall gain for the most part,
Yep.
and again, not really the most productive use of either labor or capital when it comes to what we want to see in our economy. Why would
Yep.
I want to be
Yep.
preferencing that activity with a reward that no one else
Yeah,
sees?
and you're right to note that, I mean, investments come in many different forms, and some are not actually all that illiquid. Some are very easy to, if you buy shares on a stock exchange,
Exactly.
the next day instantly sell it from your phone. Different countries, Canada doesn't do this, but some countries have different treatment of capital gains depending on how long you've held it to try and
Right.
distinguish between short and long term. So there are
I like that idea, by the way.
there are
I like that
interesting
idea.
ways to think about changing the tax system. The inclusion rate is just one lever, and I think a lot of people are too narrowly focused on the one lever. Well, of course, that's because that was the lever that was pulled in budget 2024. But
But
these issues are much, much broader.
but also, I mean, the challenge with waging a war against these changes writ large is that it fails to differentiate between passive and active
Mhm.
investments, right? And so I quite liked. I don't know if you've read. Jonathan Kesselman had a paper in the recent Canadian Tax Journal,
Reese
and
Kesselman, no?
yeah, Jonathan Reese Kesselman. Yeah, that's
Oh,
right.
yeah.
Yeah, that's right. Maybe you would know better than me. I've never met him. I think he's passed now though.
Yes,
But
yes. Okay.
so in his paper, he says essentially the only areas where increased taxation of capital gains might have significant impacts on the economy are venture capital firms, business startups, and employees in those firms incentivized by stock options. And I should pause here to note that Kesselman's paper was effectively the blueprint, from what I can tell, for these changes because he is arguing for thresholds in the capital gains inclusion
Mhm.
rate and an upper income threshold in the way that the government did pursue. And it does seem to me, at least, now maybe venture capital needs to be further addressed, but on the small business and the business startup side, they have carved out a separate regime here. So in addition to the 1.25, because they've increased the lifetime exemption for a small business by $250,000. So in addition to that 1.25 lifetime exemption, you've got another $2 million at a 33% inclusion rate when you sell your business. So you've got to, I think, hit the 6 million mark before you're even
Yep.
starting to pay more.
All right.
And if you're paying 4 million, if you earn 4 million on the sale of your business or 5 million, you're actually better off because of these changes. I can't imagine that many businesses in Canada are selling for more than $4 or $5 million. Some are selling for a lot more, but the vast majority are not. This looks like a tax cut for a lot of entrepreneurs at the end of the day,
Yeah.
or a wash.
Yeah. So that is an important point to note, that the budget was not just this one thing. It did have these other measures that were aiming to mitigate any potential adverse effect of the change on things, as you know, like new startups and smaller businesses hoping to grow in the future. And I think time will tell, and researchers, I'm sure, will be looking back on it, trying to do the analysis. And I think it's fair to say that we don't know with any certainty whether all these other changes were perfectly calibrated, too large or too small. So we'll see. But there was that effort made in the budget to try and think about mitigating those adverse potential implications of the change, for sure. So I think it's fair to say a lot of the pushback here is there's some good faith pushback in terms of like broader issues of tax design, like we've been talking about, risk and so on. But I think that the strongest one, in particular those from certain professionals
Sure.
have made decisions in the past that they wouldn't have had they known the rules would be structured in this particular way. So there is a type of windfall taxation occurring with any change in the inclusion rate because it affects decisions potentially many years into the past.
Yeah.
And that's an interesting one. That speaks more to equity and fairness than economics, since
I
windfall
think that's
taxes
right.
are in general purely redistributive, pretty efficient, but also you can understand um, from a normative perspective, maybe problematic.
I said this to a doctor in my neck of the woods, and he was very frustrated and complaining about the changes, and because he's personally impacted by them. And I said to him, well, first, changing the tax treatment of investment decisions that you've already made, I can appreciate the frustration with that. Uh, it's a big jump to go from there to suggest that this is going to push doctors out of the system, because I can't imagine that the tax treatment of passive investment within a corporate vehicle that has nothing to do with your earned medical income is going to stymie new doctors from wanting to join the profession in any way whatsoever. If you want to pay doctors more, especially in underserved communities, rural and northern communities, pay them more as doctors. Don't give them some tax treatment on their passive income that has nothing to do with their medical income at all. That's bizarre. But fair point on the fairness question of changing the tax treatment of past investment decisions.
Yeah, and on this point about paying doctors more, I mean, one interesting piece of this puzzle is it's a change in what we're defining income to be. And provinces, for the most part, defer to the federal government on that definition. Only one province does not, Quebec, but it has since announced that it too will be implementing within its own personal income tax system
Exactly.
this same change. So provinces will see considerable additional revenues from this as well. So provinces do have the capability, if indeed they have some labor supply challenges in certain areas, to adjust compensation schedules with their increase in revenue that's quite considerable, potentially equal in size to the federal government's increase in revenue. I think the feds don't put it as high, but I think it's roughly 50-50 in my own analysis. And the feds think that provinces is closer to a 60-40 gain, but provinces are looking at a dramatic increase in revenues, providing the capability to respond to the extent that these pressures are material by changing compensation design.
You've come at this and you've mostly defended the changes on the basis of a buck is a buck is a buck, as you've articulated.
Mm-hmm.
I had Sarah Perret, an economist, this was years ago now, on my podcast to talk about wealth inequality. And the OECD, her paper was focused on how do you address wealth inequality. They acknowledge, yes, we need to better address wealth inequality. We see today massive wealth disparities. I think StatsCan undercounts the numbers in Canada, if you believe a recent report out of Social Capital Partners. But if you take their report, it's something like the 0.1% of Canadians at the very top own almost 13% of wealth in Canada. I would say concerning, but I don't know if you have a particular view of this. But when it comes to addressing wealth inequality, you could have ongoing taxation of wealth, and the OECD comes and says that's a pretty inefficient way of tackling the problem, because you are administratively going to have a very cumbersome system, and people will avoid it, and it's a challenge. On the other hand, there's the taxation of personal capital income, and there's inheritance taxation, both of which exist in most countries, and you can play with those measures to better address excessive wealth accumulation. And it seems to me that the ensuring the more equitable tax treatment of investment income as against hard-earned employment income is obviously fair from the perspective of I don't want to preference my friend who's passively invested in the stock market versus the hardworking employee. But more than that, it is one of the levers to pull to address wealth inequality, and that seems like a good lever to pull too.
Yeah, this speaks to these broader issues where there are some real low-hanging fruit if you ignore politics or kind of like challenging implementation issues. So on the politics, I think a big source of inequality across individuals in terms of wealth is real estate. And if we were to
Yes.
really think about a tax change that could have big benefits in terms of equity, would be eliminating the principal exemption, the principal resident exemption from the tax system.
Which every
Or
politician will run away
yeah,
from.
I mean, this is definitely
Although
something
it's
where everyone
interesting to
agrees
note,
that no one, we're not going to do it.
it's like supply management. Everyone runs away from it, but it's very interesting. The U.S. Does have an exemption, but it's a capped exemption,
Yeah,
and
that's right.
so they don't allow you to buy a property in 1970, sell it in 2024. You
Yeah,
bought it for 70,000 or whatever it is, and you're selling it for 2 million, and you get all the gain for free. They cap
yeah,
it at I forget what it is, 300,000 or 500,000. Okay, so
yeah.
I think we're through taxes now. Okay,
Okay.
we've mostly agreed. Although I think on the capital gains, I would be probably more aggressive on the fairness piece and the wealth inequality piece, and you're more looking at it buck is a buck is a buck. When it comes to a very controversial in some quarters,
Hmm.
the number of times I've been at a door and someone said, "You bought a pipeline," when I try to talk about climate change. I was not a huge fan of the purchase, I'll be honest. I understood approving TMX, which is the next point of conversation. Uh,
Hmm.
y- Others sort of have defended this decision in different ways. The government's obviously a big defender of it. The PBO that you uh, have said very nice things about had a report in 2022 that said this is going to lose money, and then they came out in their briefing to parliamentarians, and they said, when asked, they said, and if there's further climate action, it's impossible for this thing to make money effectively. You though have come to TMX's defense in some ways. It's $34 billion between
Hmm.
the acquisition and the
Yeah.
construction, and an astronomical sum in my view. But I would probably call it a boondoggle, but you have said no, it is going to be worth the astronomical cost.
Yeah.
Convince a skeptic.
Both might be true. It could both be a boondoggle, and it could still be worth
Worth
every
it.
penny. And I think that actually would be a fair characterization of my view of this situation. So I am not going to offer an apology for the cost overruns that occurred. I think there's still some open questions around exactly why it rose from a $5 billion estimate in 2013 to a $34 billion estimate in 2024. Maybe there's a wide variety of really good reasons. And I think there are some issues that are
Yeah,
understandable, of
COVID
course.
and there are some.
Um, but no doubt we're going to have reports doing deep dives into the construction, what happened. You can easily see an auditor general report on this in the not too distant future. So that would be the boondoggle component. Like, what happened that led it to cost
Yeah,
so
but let's
much?
assume 34 billion. We're here.
Yep,
The
here we
Canadian
are.
Energy
And the
Regulator
question
says
is,
pipelines open for business. Walk me through why I should be happy
sure.
to see
So
the how do we make up the 34 billion? Let's
that's
let's
right. So
let's let's start
that's the
there.
great question. So a lot of people will look at that and think, okay, $34 billion for the pipeline. That means if the government can't find a buyer for it who's willing to pay $34 billion or more for it, then taxpayers have lost money. I think
Yeah.
that's the wrong way to think about it. Taxpayers put in $4.5 billion to purchase the pipeline up front, and we financed the construction on this project through debt. Debt that it's a crown corporation, so debt ultimately taxpayers are currently standing behind. But it's debt that, while considerable, about 27 billion in debt right now for that project, can be carried and serviced from revenue of the pipeline alone, not from taxpayers. So in the
Right.
first year of operation of this pipeline, the first full year of operation for this pipeline, it'll generate on the order of about $3 billion. It charges for every barrel that is shipped, and so that's where the revenue is coming from. And it only costs about a $500 million to operate. So it has a big operating surplus, if you will. Most of that will go towards paying interest on the debt and to repaying that debt gradually over
So
time.
so what's the but break those two things apart, because what's the there's interest on the debt, okay, but you want to make a dent in that 27 billion,
That's right.
otherwise you're losing. And so when you look at the initial upfront cost of the acquisition and whatever ancillary costs are there, plus the 27 billion in financing, however we reach that 34 billion number, you do have to, if you can't sell it for either the acquisition cost plus debt servicing, and they're, a buyer being willing to take over that debt, including the
That's right.
associated interest. How are we eating away at that? What's your, okay, put it this way.
I
You
get the question. I get the
kill
question.
interest, kill everything else. What's your profit at the end of the day that you can put towards the debt?
Right. So the amount that we're putting in that first year to debt repayment is about 600 million. In the second full year of operations, it's about 1 billion. And then it rises gradually from there. It peaks around 2030 or something at an estimate of about 1.8 billion that year for debt repayment. So the excess after paying operating costs and interest, that's put towards debt repayment. And that, depending on the scenario, and this is where we're putting an asterisk and we can circle back to it, debt by the early 2040s on the project will be closer to about 11 billion compared to the 27 that it's at today. So the question for whether taxpayers will be made whole on any sale is there a buyer willing to pay at least the 4.5 that we put into it and willing to take on the debt that financed the excess construction? And their willingness to take on the debt is contingent on what's the expected future revenues of this pipeline. And that entirely comes down to how many barrels will be shipped.
Yeah.
And over what time horizon. And so that's where there's uncertainty around a potential buyer's willingness to take on that debt. But
assume,
so the Canada Energy Regulator
assume no buyer though. Assume no buyer. So we're going to offer
no buyer. Then the issue still stands about whether the pipeline has an equity value that is going to justify the taxpayer's initial investment, and that too is about whether revenues will cover the costs of servicing and repaying the debt. And that again just depends on revenue projections. So the equity value in the pipeline depends on those future revenues. And the CER has financial filings for the pipeline, as part of the normal process for regulated assets like this. Equity value today is sitting at around 8 billion. Which is more than what taxpayers put in. That the uncertainty there is around what happens then in the future. If revenues, if revenues grow as the kind of default scenario has them, then there's no question that revenues dramatically exceed the operating costs, the interest costs, and the scheduled debt repayment, and eventually it pays corporate income taxes as well. And depending on the scenarios, this is what I kind of do in the piece that I wrote, bring that forward to the present at about an 8% discount rate. It's somewhere between 4.2 to 8.6 billion in present value terms on these profits, depending on the scenario. So there's many scenarios where the present value of that excess cash over 20 years that the pipeline generates is quite a bit more than what taxpayers paid for it. But that's where the uncertainty is. What's the revenue going to be? And maybe that's where you and I have different intuitions around that. I kind of view the pipeline as an asset that will actually be basically fully utilized for a very, very long time.
But can I ask, because I saw some people complaining that the government is banking on like 100-year timeline or something like this versus a 40-year timeline. Like when we talk about what is the brass tacks of it? At what point, if you assume, there's obviously poor projections and optimistic projections, but you assume something in between. What year do we pay this thing off that it's just making money for us?
Well, it depends on what you mean by making money.
I mean, where
it's
we
going to
operate
be profitable
in
in an accounting sense very soon. If not the first year, then the second year of operation.
Sure.
And so what I quoted there in terms of the present value of the excess cash left over after operating costs, interest payments, debt repayments, and so on, that was a 20-year horizon. And so we're thinking about just getting into the early 2040s. And I guess the reason why I'm going with a 20-year horizon is because that's what the Canada Energy Regulator
Right.
has as part of its financial filing. So the regulator is looking at the 20 years.
Right.
But we should have in mind that, of course, the life of the pipeline is longer than that. But
Yes.
if the next 20 years align with what these scenarios are, then I think there's really no problem financially. The financial question is around whether revenues of the pipeline grow as projected, and that's around how many barrels of oil are we shipping, and ultimately that comes down to how many barrels are we producing. Because the
Yeah.
Trans Mountain, it is among the more expensive pipelines now to ship oil out of, at about $11 a barrel. Better than rail, but other pipelines much cheaper. And so the Trans Mountain pipeline, that will be the one that's exposed to production declines first.
Well, that plus you add to the fact that as we see, I don't know if you believe the International Energy Agency, and you see the global decline in consumption of fossil fuels. As that declines, there's going to be competition within that demand for clean oil,
Maybe.
and maybe. I mean,
Maybe.
maybe,
And
maybe.
this is where the future of the energy sector in a world of increasingly stringent climate policy is very uncertain.
Yeah,
In
yeah,
Canada, oil sands are phenomenally expensive to get going. Like the capital investments in these facilities are enormous. And so the average cost per barrel is high, but the operating costs, like the break-even costs, once you've built the facility, are incredibly low.
yeah,
Incredibly low. And so whether or not production in Canada falls is something that requires an oil price decline that is much greater than what
right,
would be relevant for production in other
right.
jurisdictions. But
And
climate
but so
policy globally, you could think about it as being supply side and demand side.
yeah,
If there is increasingly stringent climate policies um, that lower production volumes elsewhere, that would be a world of lowering emissions and increasing climate stringency and high oil prices, which
yeah.
at the margin would be a world where we are producing and shipping more barrels than would otherwise be the case from Canada. Or you can imagine a world where the demand for oil falls considerably. And that's a world with lowering emissions, increasingly stringent climate policy, and low oil prices. So it's not a foregone conclusion, and no agency can predict where this is going to go because it's ultimately policy choices that haven't been made yet and technological developments that are kind of unknown which one of these things will be
Yeah.
larger. You
Oh,
can easily imagine a high price, low emissions future. And that would be a future where Trans Mountain is full.
yeah. Assuming that that same world that is moving towards stringent climate action is treating the emissions intensity question as a distraction. Because if emissions intensity is on the table and we don't perform sufficiently competitive, then we're going to be punished for that, right? And
Yeah. Yeah.
look, I'm
No,
no
you're right. You're right.
expert on this, but emissions intensity always struck me as a challenging proposition to be competitive on a global scale out of the oil sands.
Totally. And that would be a policy around jurisdictions levying, say,
Yeah, exactly.
tariffs, carbon border adjustments
Which the
on
EU
oil.
is about to do. But okay, so
Exactly. Exactly. And that would be, but then they layer on the added uncertainty of, well, is CCUS in Canada actually real?
yeah, not yet.
I don't even know if it is or
And they're about
not.
to blow billions of dollars. I wanted, by the way, I struck a middle ground, but I lost on. Some people are calling for an excess profits tax writ large on oil and gas, which the UK does under conservative government, but we can't do under Trudeau for some reason. But regardless, you may or may not be in favor of that. But I am always struck at the oddity of companies coming hat in hand for money to clean up their orphan oil wells, companies coming hat in hand for investment dollars for CCUS when they're making record profits. And I did think a version of a profits tax that would say you get to keep the money if you spend it on clean technologies instead of putting it on the taxpayer would have been welcome.
That's what
But
Alberta does with the large emitter pricing system here. We
exactly.
we do have some government revenues from it. Some of it also funds the very poor public relations office, colloquially known as the War Room here. But most of the revenue from the large emitter carbon tax that we levy on oil and gas gets then funneled into this entity that funds different projects to lower emissions.
Yeah.
And so I guess that's kind of a version of what you
Yeah,
are
exactly. Although I
pitching
would have
there.
left it within the company could have paid to train workers, or the company could have paid to clean up orphan oil wells, or the company could have paid for CCUS. But
Yeah.
okay, so the only thing I want to, before closing out the question on Trans Mountain, the reason I was dwelling so much on when are we made whole entirely is because of the more readily, you talked about inframarginal. Probably not many people are living in a world where they use that on a regular basis, but opportunity cost is well understood. And when you look at $34 billion expended by this government on this particular project, and you are making the case that there is an economic return to it, there are many economic returns to many different projects.
Yep.
And when I've asked for high-speed rail between Toronto and Montreal, and I get told the price tag is too high, and then I look at $34
Yep.
billion for a pipeline that I think will have a poorer return over the years than moving people. Like, we can't get federal money for subway cars in Toronto, so Line 2 is struggling in Toronto. We're more focused on moving oil in total dollars than we are with moving people. I know it's going to be more productive for the economy. And why can't we spend a similar sum on moving people around when we look at the opportunity cost is, if it's going to take till the 2040s to pay this thing back in full, which it may well, I don't know. Why can't we spend money that's going to return
Sure.
on other things?
So I think that's the wrong way to think about it. Yeah, putting Trans Mountain aside, like, and for the record, the analysis I put forward, I think that does reflect my genuine view, but I could be completely wrong.
Yeah.
So of course, there's uncertainty around that, but we could, in principle, be made whole with the pipeline if we all of a sudden there's a consortium of pension funds that want to buy it tomorrow.
Yeah.
So some of it is fundamentally uncertain around when is there a
I
buyer
hear you,
and what does that deal look like.
But I'm thinking downside risk. So sure, if there's
Yeah.
a purchaser, but
Yeah.
if there's not a purchaser,
Is
when are
there
we
an
made
opportunity cost, right? That's the question. Is
Yeah.
there an opportunity cost of this? Does the pipeline mean that we are more constrained in our ability to invest and build in major projects elsewhere?
Yeah.
There's two parts to that question. One is the answer is yes, and the other it's no. The yes, well, the construction sector itself, for projects that are of such scale, where you're demanding materials and skills and equipment, there's only so much of that. We saw that with Trans Mountain and Site C and Coastal GasLink as part of what's behind some of the cost increases. There's an opportunity cost because workers and machinery in one major project make it more difficult to do other major projects. So that's an issue. But let's put that aside because Trans Mountain is now done and then the workers and equipment are freed up elsewhere. There's no financial constraint in the sense that the cost of capital for the government of Canada is its borrowing rate. Right now, the federal government can borrow for 10 years at a 3.5% interest rate. That's, despite the interest rate increases that we've seen, right? A pretty low, a low borrowing rate, where you need to think then, well, does there exist returns of the project that one might have in mind? And you have in mind better rail or transportation infrastructure. Are the returns of that greater than 3.5%? If yes, then sell a bond, get the funds, and build the project. And the existence of other projects that the government is financing is only relevant to the extent that it's affecting the interest rate that the government can borrow.
I'll take that. I think that's probably right.
At the margin, maybe interest rates are a little epsilon higher because we built Trans Mountain than a world where we didn't. But I don't think that's the case, just because of the nature of global capital markets.
Yeah, I think that's probably right. So instead, I should be thinking about this as, you feel so great about your business case on Trans Mountain. We should be doing more of these nation-building projects.
Yeah,
I should be flipping
you
on its
will
head.
not find an argument from me against increased infrastructure investments in Canada across the
And
board. All
you and
modes,
I, how old are you?
sorry,
How old are you?
40.
Okay, so I'll be 40 in June. So in we're gonna wake up when we're both 75, and we'll revisit the conversation and go, who was right? um,
Yeah.
okay, I want to close this out on the question of productivity. It's come up many times in this conversation already, but you have, I think, softly, but in your way, softly criticized the budget in a sense, and you're not alone. Kevin Page did the same effectively to say, it's not, this is a tax and spend budget. It's not to say these aren't worthwhile initiatives, whether it's the disability benefit, whether it's defense, but it's not focused on productivity in a way that it ought to be. And I think you would overall share that general concern. Uh, what do you want? Say you're sitting in Christia's shoes. You want this to be a productivity focused document. What do you want to see in there that is not in there?
That's a great question. I'll start with maybe a long preamble where I just openly recognize that governments have a hard job to do. There's a lot of competing priorities, and to have a budget like Budget 2024 not focus on productivity is fair enough. There are lots of other challenges, and it's not for me to critique the priority ordering here. The government, in its own messaging of the budget, is quite clear that it's focused on affordability issues, housing, rent. It points to other initiatives, school food program, the childcare and pharmacare issues, increasing support for seniors. There's a whole list of things, and growth and productivity is only ever just the one of many issues that they focus on. And so, governing is choosing, and that's fair enough. If they were to have had a productivity focused budget, what might it look like? Well, there's no, unfortunately, silver bullet here for something that the federal government can do to fix the productivity challenge. I think there are some things. Tax reform is one. This is something where we're at a moment where it makes more sense now to think about whether we're structuring the tax system in a way that a renewal of it would make sense. Because starting this year, various features of the federal tax code are going to be gradually expiring between now and 2027 that effectively increase the tax rate on investment. In 2018, we enacted many changes in response to the US major tax change that they did in 2017. So a big change in the US. Naturally, that raises competitiveness concerns in Canada, which we responded to. But now what we did is expiring. And so having our thinking caps on around how we can either make permanent the things that we did in 2018 or enacting some other reforms rather than allowing for those effective tax rates to return to their pre-2018 levels, I think makes a lot of sense. If we look over the past 20 years, so since 2000, nearly 90% of Canadian labor productivity growth came from capital per worker increases. So investment is a critical piece of productivity growth, and taxes on investment are a big part of that. And I don't mean lowering the statutory rate on corporations. There's other levers that can be pulled, so that would top the list. But second, it would try and, I guess, think about the very functioning of the country. We are incredibly decentralized in a way that maybe most Canadians don't really appreciate just how little power the federal government has over lots of important areas that matter for productivity growth. And I do a lot of research on issues like interprovincial trade. So I'm going to point to that issue just because it's on my mind a lot. The feds can't do a lot here. These are largely about provinces having rules and regulations in their own spheres of jurisdiction that just differ from one another. And that creates frictions if you're trying to operate across borders or even producing in one and selling your product or your service in another. And that's not something that the federal government can certainly unilaterally change. We had a Supreme Court case on this in 2021
Yeah.
involving someone shipping beer from Quebec to New Brunswick. It's a very interesting case, and basically the Supreme Court ruling that, well, as long as a province is not explicitly taxing trade from another jurisdiction, then almost anything else goes. And that's fine. We're a decentralized country, but having better coordination across governments, maybe that's a role for the federal government to take on more. And that's easy for me to say because politics being what it is, that Fed-Prov tension is this natural dynamic throughout Canadian history that makes coordinating governments across the country really difficult. But the gains from improving and having a more harmonized approach to regulations in different critical areas is very important. I look to Ontario. What has that government done recently that I think is quite interesting? It's unilaterally recognizing certain types of health professional credentials in the province. You know,
Yeah.
if your skills were good enough to deliver those health services in Manitoba, then they're automatically good enough in Ontario. And it's simple things like that that, if rolled out by more provinces in more areas, there could be some really big gains.
I, I was reading Andrew Coyne. I saw it only because you retweeted it. But Andrew Coyne had an article about sort of growth and ideas that we could better focus on. It struck me though on the labor side, and it's all about labor and capital and putting them to use and making them more productive. But he says, as a starting point, we should be doing everything we can to increase the supply of labor. Okay, we've got a very aggressive immigration policy. So that should be a box checked on his column. We have massive a massive expansion of the federal role in childcare, which is going to have associated increase in the labor supply.
Yeah, that's right.
As we follow
Yep.
Quebec,
Yep.
one can argue it on different grounds, but you can't argue the labor force participation element.
Yep.
And
To be
so,
clear. And we
from
already
a
may be
broad,
seeing that in the data in a big way.
right, exactly. And so, from an economic perspective, in terms of labor participation, that's a big productivity enhancement from the feds. You, I think, would join Andrew Coyne in saying you should look at lowering personal income taxation, and you even have suggested you could have used some of the gains out of capital gains to do just that. Um, in fairness to this government, yeah, they increased at the top end, but they decreased it by even more in the middle bracket, and it wasn't even just a wash; it was a tax cut overall.
Yeah.
They've also cut taxes by virtue of, I think it was a wasted $6 billion a year, but it was expanding the basic personal amount was an effective tax cut for millions of Canadians,
Yep.
and that's why it cost $6 billion. So, maybe there's more to be done there, but it's not like there's been nothing. And so on the labor side, I look and go, okay, but I don't what more do you? I mean, other than on the personal income tax side, and we heard Poilievre saying he's going to cut taxes with it, telling us how he's going to pay for it. But regardless, that's a significant amount on the labor side. On the productivity side, on the capital side, I take his point. On the competition side in particular, if I were holding the levers of power, I would go wild on this because I think there's also a populist element here that people
Yeah.
want it. We want competition in telecommunications. We want competition in banking. We want competition in aerospace sector. So I don't know why we don't embrace that in a more serious way. It
Yeah.
checks the box on productivity, but politically, there's demand for that.
Yeah, I guess, do you recall when they tried to allow Verizon to bid on some of the spectrum auctions? I guess it was
Sort of, yeah.
15 years ago. I forget the exact time. And then TELUS, I'll pick on them because they were most visible
Yeah.
in my head, launches a massive, truly massive public relations campaign in opposition to this, creating
Yeah.
enormous pressure on the government. So you might be right that it might be popular, but that's a
You're picking a
risky
fight.
move. But yeah, picking a big
Yeah.
fight. But
And
I
and
agree
then
with you. Competition is absolutely it's a source of productivity gains in the sense that it would then keep businesses on their toes a little more, thinking about ways of doing things better at lower cost, better quality. Because if it doesn't, some competitor is going to take away market
Yeah.
share from it. And in Canada's case, that often does mean restrictions on foreign operations and foreign investment, which are very large in some sectors like telecommunications. So aside from just the potential and I think near certain PR response from industry in these areas. There's also a bigger question about foreign firms in the Canadian economy
Sure.
that, while I don't put a lot of weight on that, it's certainly a reasonable concern for a smaller country close to the United States to wonder whether it would willingly take the economic hit in terms of lower productivity to achieve some other goal of maybe a more amorphous but still valuable sovereignty goal. And that'd be
Yeah.
fair
Well,
enough as a conversation to have, and that's why we have these restrictions in telecom and air transport and so on.
I was on a committee with Pierre Poilievre a few years ago, and he had a motion on cutting red tape. He sees red tape everywhere. And I was like, okay, I'll support the motion if you add it to address competitiveness overall, including reforms to the Competition Act. And so we amended it together. We passed it together, and we did a study on it. Uh, it's funny though, because on he's also kind of gone to war against digital IDs, but there's massive efficiency gains to be made there as well. We see from Estonia, it was like 1 to 2% of their GDP they saved by moving things more online, so which we apparently have a hard time doing. And then on the uh, we could have a long conversation about corporate welfare and what works and what doesn't, and it's an ongoing frustration in some ways. But on the anemic rate of investment, I want to close it there because it brings us back full circle. It does seem to me, and I don't know the magic of this within the tax code, how one does it, but it does seem to me that we should be treating passive income and active income in a different way if it's possible,
Yes.
and we should be incentivizing firms or punishing firms who are not investing in their own. Uh, the share buybacks. I know we've tried to address, and capital gains addresses it in some way. The changes addressed in some ways, but we have seen anemic private sector investment in their in from a firm basis. What is it? Business enterprise research and development, BIRD or whatever, is like well below what the U.S. does. I don't know what the tax changes are specifically to address that in full, but
Yeah.
that's got to be an
Yeah.
overriding focus if we care about productivity.
And this connects right into what I noted about the 2018 temporary changes that Canada enacted, and which there's scope to go even further towards. So if I were to imagine a corporate tax system that really ratchets up the incentive to invest, it doesn't necessarily involve cutting corporate income tax rates at all.
Yeah.
At all. It just means you would treat a dollar spent on investment the same as you treat a dollar spent on operations in a firm. You would allow for full and immediate expensing.
Right.
That, in principle, can bring the effective tax rate on new investment to zero, even in the presence of a non-zero corporate rate overall. And that, the way you phrased it, this difference between passive and active, would create this difference between the effective tax that we're treating on new investments flowing in versus the returns from past investments that were made. That would still be determined by the statutory rate. And so having a permanent full expensing approach to corporate income taxes, if I were to point to one thing to move the needle on taxes, it would be that. And that's hopefully something we talk more about. I mean, the political challenge here is how do you get Canadians engaged on a conversation around accelerated capital cost allowances? It's something that doesn't really resonate, but can dramatically change incentives while maintaining taxes on these returns from past investments, as you put them.
Yeah.
So
Well,
it'd be
politically, I
changing
think,
the
look,
margin that we want to change rather than lowering the statutory rate, which creates benefits to even those with, as you put it, passive income.
yeah, I don't have a perfect formula for the politics of it, but I think fairness is a very powerful idea in politics, and we should, as a liberal party, I'm glad to see them go back to that idea, because it's incredibly important. I do think competitiveness and productivity are also very powerful ideas, especially when you want to talk about our standard of living and improving our standard of living and making sure we're all better off by having a really and frankly tie it to what's best for consumers as well. I think we do a poor job of thinking of it from the perspective of how do we make sure consumers are better off? Well, it's through a really competitive economy. And how do we get the most competitive economy that we possibly can? So I think there are lots of different ways of bringing it back, bringing the politics back. In the same way that I think when we talk about housing, we've talked about it almost exclusively as a fairness challenge. But when I read Andrew Coyne on the labor side, and we should be doing everything we can to increase the supply of labor, yeah, we should also be doing everything we can to attract labor and to keep the labor we've got here. And if you're not making sure that housing is keeping pace with incomes, then good luck to you on the productivity side. If we don't talk about it as a twin challenge of fairness and productivity, we're actually not going to be as ambitious as we need to be. Okay, so we have managed to talk about taxes, pipelines, and some combination of taxes and productivity policy for almost an hour and a half. So I really do appreciate the time.
My
I had a
pleasure.
guest, Brett House, on a previous podcast,
Oh,
who I
great.
don't know if you've analyze this idea, but as you are looking at uh, addressing interprovincial barriers, his idea was throw billions of dollars into a fund from the federal government's perspective and basically just bribe the provinces to do the right thing, the way they ended supply management in Australia and New Zealand.
Yeah. I think that'd be the only way to do it.
Yeah.
And it doesn't even need to be new dollars. You could repackage some existing federal transfers and just say there's a new condition on them.
Or
So
we could take $34 billion in borrowed money.
yeah. Yeah. Oh, yeah. There you go. The returns are definitely more than 3.5% on that. So.
Well, with that, Trevor, by the way, thanks for allowing me to get into the weeds here. And thanks for your time. I really appreciate it. And thanks for all you do, adding your voice as an academic into the public debate and public conversation. It's appreciated.
Oh, thank you. It was really great to be here and great conversation.
Thank you.